Hello and welcome to The Enterprising Investor, this flagship investment podcast for CFA Institute. I'm Mike Wallberg, and I have Stefan Sharkansky in the studio today, principal of Useful Work, Inc., a pioneer in direct indexing for individual investors. Listeners may know him for Personal Fund, a cost analysis platform for mutual funds and ETFs he built that's used by advisors. With degrees in mathematics, computer science, and statistics, Dr. Sharkansky recently published The Only Other Spending Rule You Will Ever Need in the Financial Analysts Journal. And he launched The Best Third, a web-based retirement planning tool to create tax-aware, sustainable income plans based on his research. We're going to talk about that research today. And spoiler alert, Stefan's modeled a solution that threatens to unseat the hallowed 4% rule of retirement spending. Welcome to the show, Stefan.
Thank you very much. Glad to be here.
Now, Stefan, we'll get into the guts of your theory, but maybe just set the table for us first here. For, I don't know, call it 100 years, advisors have been using variations on the relatively simple 4% rule. But you've developed a smarter mousetrap, as I mentioned off the top. What is the 4% rule, and how are you approaching retirement planning differently?
Sure. Well, it's not quite 100 years, it's more like 30 years. But in a Journal of Financial Planning article about 30 years ago, Bill Bengen did some historical research on the US stock and bond markets going back to 1926. And he was trying to find the safest constant withdrawal rate from a roughly 60/40 portfolio. And he found that 4% is the maximum rate of constant withdrawals. That is 4% of the original, what you start out in retirement. So you start out with $1 million at age 65, and he wanted to see what constant rate of withdrawals could last for 30 years without depleting the portfolio prematurely. And he found that 4% adjusting for CPI every year of that original $1 million, so $40,000 a year adjusting for CPI, would survive any market scenario, including the worst scenario at that time, which would have been starting in the late 60s and having the hyperinflation and bear market of the 1970s. So since that time, people have said, okay, so 4% rule, that's an easy number, and it's an easy rule. We can follow that rule. But that simple rule has been criticized by many researchers for several years as being one, too simplistic, two, not necessarily safe, because in a worse market scenario, you could deplete the portfolio prematurely. And three, the opposite of being too safe, not entirely safe, but being very safe, is that it's going to lead to chronic underspending. And another criticism is that, well, it assumes a constant withdrawals when in fact withdrawals during retirement, spending during retirement isn't going to be constant. There are different patterns where spending typically declines during retirement, spending is lumpy during retirement, and taxes are not constant during retirement. So, for all those reasons, it's time to look for not the constant safe withdrawal rate, but a variable spending rule which adapts to market conditions which vary and also to retirement spending patterns which vary.
Right. And so tell us a bit about that. What does that look like? How do you set that portfolio up on day one?
Okay. So the portfolio on day one consists of, in my paper, two assets, very simple. One is a ladder of tips held to maturity, and two is a stock market index fund. And this strategy is based on two works. And let me back up and set the context for why I got into this problem. And it was a conversation my wife and I had a couple of years ago. We're now in our early 60s, and she asked, "How much can we spend in retirement from our retirement savings?" And I said, "I have no idea, but I'll research it and get back to you." And doing the research, I read a great many papers on the topic of retirement accumulation. And there were two works which stood out as the best guidance for that problem. One is by William Sharp, the Nobel Prize winner. He came up with a concept called lock boxes about maybe 8 or 9 years ago. He published it in a monograph on his website. It didn't get as much attention as it deserved, but it's a very powerful concept, which also starts with the ladder of tips and a risky asset. The other work, which is framed very differently, but mathematically identical to what Sharp was proposing, appeared in the Financial Analysts Journal in 2015 by Waring and Siegel, called the only spending rule article you'll ever need. And I found it's very similar to Sharp, but it's framed a lot better. I thought a more manageable framework. And my paper is really an extension of the Waring and Siegel FAJ paper. And so, in homage to them, I call it the only other spending rule article you'll ever need, because it starts with what they did and it extends their model in a few ways, and it converts their wonderful theory into an actionable framework which a practitioner or a sophisticated DIY investor can follow.
Gotcha. So you have a tips ladder basically that's matching off as I understand it from your paper, that's matching off your known sort of minimum spending that you're going to need to cover your cost of living. And then the risky portfolio is kind of, in my mind, gravy on top of that if you want to have lifestyle beyond your sort of your bare minimum. Is that sort of accurate in terms of how that structure is meant to work?
Yeah, that's accurate. The tips are there to supplement your Social Security and any other pension you might have, any other non-portfolio income sources, maybe rental income. So all those non-portfolio income sources, plus the cash flows from the tips ladder, that gives you what I call base income. And that's what you can rely on to, particularly with Social Security and the tips ladder, rely on for predictable inflation indexed income for many, many years. And in addition to that, managed separately from that is your stock portfolio, which you use an amortization formula to spend down. And it's a similar amortization formula that is used for calculating mortgage payments. And you spend down your stock portfolio using this amortization formula. And what that gives you, the formula gives you specific percentages of that stock asset to withdraw every year. But because the stock market values are volatile, you don't know in advance what the actual dollar amount of your withdrawal is going to be. And I call that the bonus income. Like most of us in our working lives, or many of us in our working lives, we have a base salary plus some kind of a bonus, which may depend on our personal performance or company performance. In this framework, you have your bonus income is based on the stock market performance. So you know in advance what percentage of your remaining outstanding shares to withdraw, but the actual dollar amount will vary with the market performance. And that's a way to sustain that kind of spending over your lifetime, is making your actual withdrawals to vary with market performance.
I see. So you stipulate on day one that you're going to be withdrawing, I don't know, pick a number, 2% or something like that of your, I don't know what the scale of it would be, but some X percentage of your equity portfolio each year on January 1st, regardless of what it's done in the last year. Yeah.
That's right. That's right. And from the amortization formula, if you have a constant 30-year spend down of your stock asset, the first year, it's actually more like between 7 and 8%. You can't count on that same dollar value every year, but similar to the RMD formula, required minimum distribution of your retirement assets that the IRS mandates in the United States, the percentage that you withdraw from the remaining corpus of your asset increases over time.
Gotcha. And you mentioned it before, the retirements have different shapes, right? You have decreasing, declining. There was a smile shaped. So can you talk a bit about how you structure this portfolio to address that potential sort of spending pattern in a retiree's account?
Yeah, absolutely. So the typical retirement household decreases its spending over time. You go through the what are sometimes called the go-go years of early retirement when
Mm.
you're young,
Travel.
relatively young, healthy, travel, leisure. And then as you move into your late 70s, 80s, those become the slow go years where you're more sedentary. And finally, at the end of life, it's what they call the no-go years, where you're really not doing anything very much, but you may have increased healthcare needs. So that's where the smile from David Blanchett's 2014 paper comes from. The spending pattern is high at the beginning, then it dips, and then it goes back up again toward the end. And so to achieve withdrawals that match the smile shape, first of all, with your tips ladder, you can create the ladder so that the cash flows from that ladder follow that pattern. That's relatively easy to do. And you can also control there's a formula in the paper that says how you can control the withdrawal percentages from the stock portfolio such that the expected withdrawals, expected in the statistical sense, how the expected withdrawals can also follow that pattern by weighting basically you weight the present value. Think about it this way. It's similar to Sharpe's lockbox philosophy, where you create a an amount for every year of your retirement plan, and you place in the box for every year a present value that has the expected future value that you want to be able to spend in the future year. And so if you weight those future values appropriately, you can set it up so that the expected future values follow that smile shape or whatever shape you want. And of course, because the market returns are variable, you're not going to achieve exactly that smile shape, but you can have the expected returns and expected withdrawals match that shape.
Yeah, it sounds in many ways like a liability-driven investment approach for a pension plan effectively. If you know the shape of your liability stream going forward, you can kind of dynamically in advance build something that matches off against that effectively, right? That you're just doing all the math up front.
Yeah, that's exactly right.
Okay. Well, one of the things I was gonna say about that, and I'm just curious your thoughts on this. LDI as an approach had popularity that's gone up and down in reverse proportion to to interest rates because, as you know, low rates make immunizing portfolios much more expensive. I imagine that this strategy would have been much more difficult to implement even 5 years ago. Today, it's a little bit more normal time. So, can you talk to a little bit to the use of tips and the cost of immunizing those minimum spends over time.
Yeah, absolutely. So today we are in a fortunate interest rate environment that real yields are above the historical average. And so a constant 30-year tips ladder, you can spend every year about 4.5% of the initial amount you put into that. That's very generous. So about 5 years ago, when tips yields were zero to negative, it was a lot less attractive. So you would need to achieve the same level of base income, you would just need to have more of your portfolio in tips. But, it's a trade-off. The trade-off between the tips allocation in this type of portfolio and the stock allocation is based on how much secure base income you want. The way I approach this, it's not the typical accumulation stage asset allocation where you say 60/40 or 30/70 or whatever your volatility tolerance is. This is based on your tolerance for volatility of the base withdrawals that you have.
Right. Right. So for more certainty, you pay more for it, right? Even if accept low yields. Yeah.
That's right.
Yeah. I actually had a question for you on that as well. So I get, and maybe this answers this. It was my question for you was why does it have to be like absolutely risk free? Tips being obviously inflation protected treasury securities. Why no risky bonds in there? Like no, or not risky bonds, but like even investment grade, a sleeve of that in there. Like what was your thinking behind going purely tips?
Okay. So for the secure base income, you want to protect your spending capacity. So the cash flows from tips are inflation indexed. They're the closest thing that we have in the public markets to the classical risk-free assets of financial security. If you hold the tips to maturity, you have a risk-free asset in terms of the cash flows down the road. If you use, say, nominal treasury bonds or nominal muni bonds, you're subject to inflation risk in addition to, well, if you hold something to maturity, you're basically taking the interest rate risk off the table, but you still have inflation risk, and that's something that we need to worry about. As far as why there are no risky bonds paired with the stock asset in the risky part of the portfolio, this was an open question. In Sharp's formulation of this, he said use the market portfolio for your risky asset, which includes global stocks, global bonds together. Warning and Siegel left the a question open of what should be in the risky asset. But I did the analysis and I compared various allocations of bond funds and stock funds.
Yeah, this was really interesting in your paper. Sorry, go ahead.
Yeah, in the risky asset. So what I found, and this was, I think, one of the more interesting findings, is that if you're going to have a risky asset that you amortize down, then an all stock portfolio is the way to go. I looked at different combinations of 60/40, 80/20, et cetera. And what I found is that for the purposes of decumulation and amortization in the style, that adding bonds only decreased the upside without adding very much downside protection. The downside protection comes from your tips ladder. Tips are bonds. And so I'm still saying you want to allocate both stocks and bonds into your portfolio, except for this retirement decumulation, the specific bonds and the way you hold the bonds is, excuse me, laddered tips as opposed to volatile bond funds.
Hmm. Yeah, it's counterintuitive that it would protect or give you raise your median income without giving you worse downside. So it's kind of amazing. But I guess that's the value of having that tips protective layer there.
Right. The tips are simply more efficient at protecting your downside in this use case than volatile bond funds. And where it comes from, I think, is, and I tested this using the empirical data, Robert Schiller's data set of US stock and bond and inflation going back to 1871. And what I found, and consistent with what other people have found, like Jeremy Siegel and others, is that stocks mean revert over the long horizon. So the long-term returns on stocks are not the IID independent and identically distributed bivariate normal that finance theory tells us it is. The empirical returns are a little different. So you don't, because of the mean reversion over the long term, you simply don't have the downside that the more classical parametric model of stock returns tells us we should expect.
Gotcha. I want to dig a little bit, not too deep in, but a little bit deeper into the ARVA calculation, so annually recalculated virtual annuity. So as I understand it, you've got inputs there: expected real return, remaining horizon, and your spending shape that we talked about before. What do you plug in there for real return, and is that dynamic at all, or is that a set number at the beginning?
Yeah. So what I did was for the basically the amortization discount rate, I use what I imagine my proxy for the expected real return. We don't know what the expected real return on stocks in the future is, but what I say is let's take the long-term historical geometric mean return, real geometric mean return of stocks, which over the long period in the Schiller data set, going back to 1871, is 6.9%. That's been the geometric real return on the US stock market, 6.9%. So I plug in that number for the future expected return. I don't have capital market assumptions. I don't have the skill or the insight to predict any other capital market assumptions. If other people do, then they're certainly free to use their long-term expected future real return on stocks as their value.
Okay, that's interesting. So just tell us a little bit about, is this the bestthird.com? So is this a tool that folks can use for generating these calculations?
Yeah, exactly. So I created the website thebestthird.com, where I implement a tool based on the research in this paper to do your own retirement income planning. And you can plug in assumptions like your social security, time horizon, plug in the values of the assets that you currently own. You specify the level of target base income that you want, and it uses the results from the paper to compute what that tips ladder should be to match social security, et cetera, for your base income using the shape that you want. And then it models the rest of your assets in stocks, and it uses the formulas from the paper to compute your income, your base income plus the range of your total after tax income based on what historical stock market numbers have been. It computes a range of what your total income, including base plus bonus from stocks, would be. And it goes beyond what's in the paper. The paper specifically said we're not going to deal with taxes. That's a whole nother can of worms. But in the implement
Right. Yeah, because tips can be problematic a little bit in that space, right?
Tips are great in taxable accounts, but what the Best Thirds website does is it estimates federal tax, and it will, for the reason that tips aren't great in taxable accounts, it will locate the tips assets primarily in your tax deferred accounts, your traditional IRAs and your 401ks, because that's where they work best for tax reasons.
Right. Okay, gotcha.
And the website is free, by the way. It's not monetized at this time. Anybody can try it out, and both practitioners and individual DIY retirees can try it out and see how the concept works for them.
What does the best third mean? What's the meaning for that, name for it?
Yeah, great question.
Best third of your
So,
life?
best third of your life, exactly. We have think of your life as in three thirds. The first is growing up and going to school. The second is your working years and raising a family. And the third is your retirement. So the site is about giving you the financial knowledge and tools to make the most of that third of your life and have the best experience in retirement.
Well, we'll talk about outperforming expectations on an answer to your wife's question, hey? You went out and built a whole theory and a website and everything else. Are 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 you using it for your own planning?
Yeah, absolutely.
Yeah,
Absolutely.
that's great. Well, we're coming to the end of our conversation here, Stefan, unfortunately, but we have a two-part question that I like to ask all our guests, which is what was your first job in the industry? And if you could go back and take yourself for coffee on your first day, what key piece of advice would you offer yourself?
Well, my first job ever, as a teenager, I was a paper boy when my family was in Australia for a few months. My first job in the investment industry is when it was another entrepreneurial job. I was self employed. I came up with the concept of direct indexing. I was one of the very few who saw that as the next direction of investment management back in the late 1990s. I was one of the very first to come up with that, and I that's what personal fund started out as, to be your personal fund instead of your mutual fund. And I worked on that. Unfortunately, the collapse of the dot-com bubble made it hard to raise money, but I salvaged pieces of that, and that's uh, became personal fund that advisors continue to use to learn about costs of mutual funds and ETFs. If I was a mentor to give myself advice, I would say don't start a company that you can't bootstrap. Don't start a company with the idea that you need to raise a lot of capital in order to get started. So bootstrap from your own resources and build something, and then people will come.
Great advice. I've been speaking today with Dr. Stefan Sharkansky, author of The Only Other Spending Rule You Will Ever Need in the Financial Analysts Journal and founder of both The Best Third and Useful Work. Thanks for speaking with me today, Stefan.
Thank you so much. I enjoyed it.
I'm Mike Wallberg, and this has been The Enterprising Investor.